Okay, so don't tell anybody I told you this. No, it's true in a way. They when they hired me to teach the class, they asked that it be rigorous, and I'm not really sure what they meant by that because I'm not a PhD. I don't, I, I asked myself, what do these students need to know? And I think the answer I came up with, and it's at the engineering school, by the way, not the business school, the engineering school. So I doubt that partner committees really achieve consensus. I think they horse trade. I think what you have to do is not get everybody to believe you. And I think if you could get everybody to believe you, then maybe it's the wrong company. Like if everybody agrees that this is this is going to be $1 billion company, well, it probably won't be, right? Because the ones that become really big are the ones that are unusual. They're different in approach.
Do venture capitalists provide valuable advice for entrepreneurs? What do you think?
Okay, so I'm a venture capitalist. I invest in startups. That's what I do. I think my advice is really valuable. Um, I may not be entirely objective about that. So I think in my experience, venture capitalists sometimes provide good advice and sometimes don't. There's places where venture capitalists can almost always provide good advice, right? So you think about what a venture capitalist does for their job, they help people raise money, right? And that's what they know best. If you're raising money or you plan to raise money in the future, a venture capitalist can help you a lot. Their advice is very good. They know the market, they know how to do it, they know what other venture capitalists are looking for. They can help you craft a story that will help you raise money. Um, if you're looking to hire, top level executives, they can probably help you there, right? If you're hiring a new CFO, a new CTO, a new COO, they're involved in that, right? That's what they do as part of their job. If you need help writing unit tests for your developer, like they're not going to be able to help you. If you need help finding customers, they might be able to help you, but that's not really their job, right? They're not out talking to customers every day like a good salesperson is. So I think you want them to help you do the things that they know how to do, and those are only a few things. Now, some VCs might have come out of a sales background and may know some specific things about building a sales force or how to pitch customers, and they could be useful for that. But in general, you have to find what the VC is good at before you ask them for advice. Is my opinion. I
Also,
mean,
can you describe your framework for making investment decisions, especially in early stage companies? How much do you rely on data versus intuition when evaluating potential investments?
well, so I invest as early as I can, right? It's usually two people and an idea. Um, so there's not a lot of data. There's data about the market they're going into. There's data about competitors, and I use that data. I focus in specific markets over. They change over time, but at any one point in time, I'm focusing in a couple of specific markets. So I know the markets pretty well. I don't have to go out and do a bunch of research because I've already done that. So when people pitch me, I can evaluate whether they have a good idea and if they know what they're doing. And typically, I'll only invest if they know a lot more about the market than I do. So, but I have a basic understanding of what they're doing and whether it will work or not, who the competitors might be. But other than that, there's not a lot of data. It's not like they have 2 years of income statements that I can look at or any of that kind of thing. They may be talking to some customers or know some customers, and I could talk to those customers, but it's pre-product. So I don't think a lot of that kind of due diligence is going to get me anything. But that's it's different, right? Depends on your stage.
Did you have the sense when initially investing in trade desk?
So yeah, so when I first met Jeff, the founder of Trade Desk, he was starting a company in a market I knew really well. My startup had been in that market, and I had invested in a couple of companies in that market already. So I knew what he was trying to do, obviously he was an amazing founder, and I think it wasn't clear to me or to anyone, I think, whether what he was doing would work. He was taking a different approach than everybody else. Everybody, and it was a crowded market, right? The ad tech market at the time was crowded, and he was saying, everybody's doing it this way. I'm going to go do it this way. Um, he had a really hard time raising money. In fact, it was not easy to convince people to invest in his company. Um, and for me, I didn't know if his way would work or if the other way would work. So I invested in both of them. I invested in companies in both ways, which is what you can do as a venture capitalist. You're running a portfolio, right? So, I actually, there's a blog post I wrote, God, it had to be 15 years ago, where I said, here are 5 different ways the ad tech market could turn out. And I invested in 4 of them, that 4 different ways. The 5th way, the ad exchange, was already too well developed for me to invest in, but the other 4 were still open. And I said, one of these 4 is going to be it. So let me invest in a company in each of these 4 ways. And Trade Desk was one of them, and they ended up being the winner.
You mentioned about the VC sell founders on promises that do not always materialize later, like recruiting, help, or introductions. What advice would give founders on doing due diligence during the fundraising process to determine if VCs will really deliver on what they promise?
Yeah, so when I meet a founder that I like and I think they have a good idea, the first thing, the real due diligence I do, the thing that really helps me decide whether to invest or not, is I pick up the phone and I call somebody who knows them, who has worked with them, who, either they've worked for or they've worked with or has invested in a company they worked for. I almost always know somebody who knows them somehow. Um, I don't ask the founder if that's okay. I just do it, right? And I think every founder should expect that their investors are going to talk to people around them and say, who is this person? How are they? How do they work? Are they worth working with? That kind of thing. I don't, that's just how I do my work. How I do due diligence. I would expect founders to do the same thing, right? It's you're not working with a VC firm. You're working with a VC partner. You're working with a person, right? And that person is making a decision, and that person is going to work with you for the next 10 years if you're successful, pretty closely. They're going to help you decide about raising more money. They're going to help you decide about either exiting or growing or whatever you're going to do. They may sit on your board, so you need to know something about that person. And I think the only way to really find out about a person is to talk to people who've worked with them. You can go read all their tweets, and you can go read their blog posts, and you can read the news articles written about them, but none of that stuff is real, right? None of that stuff really tells you who they are. That's all public relations, right? So you want to talk to other founders who have taken their money, and I don't think you should be shy about just calling. It's like, oh, this person invested in these 5 other companies. I'm going to call the founders of those 5 companies. You don't have to ask the VC. You shouldn't ask the VC. You should just pick up the phone and call. And most people will be willing to talk to you if you say, hey, so and so is looking at my company. I'm thinking about them as an investor. I know that you've taken their money and they're an investor in your company. What do you think about them? How do you work with them? Tell me something about them, and people will usually be happy to tell you. If they're not happy to tell you, that's a problem, right? So, I mean, you're not going to call and say, hey, do you think, Joe VC is a great investor? Is he really helpful to your company? And if the person on the other end of the phone says, yeah, they're fine, they're okay, yeah, sure, it's okay. Like, that's a bad reference, right? That's somebody saying, do not take their money. If they don't say something like, what, they're super helpful, they've really, been the best VC we've ever had, people always kind of move to the positive side on these things. So I think you should call it and say, who is this person? How do they work? Are they easy to work with? Should I take their money? And see what people say.
Are there any specific red flags for you when also in the investment meetings? Similar questions, what should be the red flags for the founders to accept the investors?
Um, I think you can see a lot of red flags in what investors say to you. Sometimes they think that they are putting their best foot forward, but in fact they're telling you something you probably don't want. So if an investor comes in and says, hey, you and I, we're going to be in the phone every day. I'm going to roll up my sleeves and sit next to you and help you get this done. That's a red flag. This is your company. You have to run it as the entrepreneur. The reason the investor is investing in you is because they want you to run it, right? If they wanted to run a company, they could go start a company and run a company. They're investing in you to run it. So if they're going to be there next to you, helping you run it, you don't want that. That's a bad thing. That's the kind of micromanaging, somebody getting involved who isn't really all in on your idea. You want them to be there to help when you need it, but not to offer help when you don't need it or don't want it.
From the founder side, what should be the red flags not to accept the VC money?
Oh, sorry, that was the red flag not to accept VC money. Sorry, I got the question backwards. What are my red flags in not investing?
Yeah, Right.
Yeah. No, so okay, let's flip the questions. That was the answer to your current question. Let me answer the previous question. So when I talk to somebody, I mean, it's all red flags, right? I mean, it's, somebody comes to me and says, "Hey, you don't know me. I've got this idea that nobody likes. Would you give me money?" I mean, it's all red flags. It's, nothing but red flags. You know, that, but that's the job, right? That's the job of the VC, is to say, okay, in this sea of red flags, can I find a path through? Is not even can I find it, but is there a potential path through? Because we bet on the outliers, right? We bet that somebody can overcome all those red flags, either through skill or luck, and usually luck, right? Because if they were incredibly skilled, they'd probably be the CEO of, Apple or something. So, it's kind of a trick question in a way to ask a VC, like, what are your red flags? Now, if you're saying red flags, like, what would absolutely stop me and say I would never invest? It's usually either because the founder has been dishonest with me or
Mhm.
untrustworthy in some way. So they've told me something which turned out to just not be true and they knew it wasn't true. Um, or they've made me a promise or said they were going to do something and then just not done it. And this often happens when you're putting a deal together and they say, "Oh yeah, you can, and you'll be able to invest this way." And they come back and be like, "Nope, that's everybody else is investing the other way." No, if you handle that correctly, you say, "Look, there's nothing I can do about it. It was pushed on me, whatever." But I want people who are going to do what they say they were going to do, and that's important to me because later in the relationship, after you've invested, if they do things, I mean, it's you don't as an investor have control of the company. So if the founders aren't doing what they said they were going to do, you can get screwed, right? So that's one of the big red flags. I think the other red flag is people who aren't ambitious enough. So, people who are like, "Well, I can build a $30 million revenue company and then we'll sell it." It's like, well, that's not going to work for me, right? And a lot of founders think that's a great outcome, and it is a great outcome if you haven't taken venture money, right? You build a $30 million revenue company. I mean, that's a big company to have built, but if you've taken venture money, that's not ambitious enough. And I think if you want to find the people who are ambitious, and I often ask them, what do you want this company to look like in 5 years? And the correct answer is something like, I want it to be 100 million in revenue and growing, 50% a year. I'm going to take it public in 7 8 years. We're going to be the biggest company in the world. No, it's not that I believe that, right? I mean, it may be. I mean, well, it's happened, right? It happened with Trade Desk. I mean, if he had told me that, I would have been like, okay, sure. But it's the ambition that you want. You want people to take an idea and make it a bigger idea. And if they can't do that, then maybe venture capital is not the right way for them to go. There's plenty of other ways to start a company and raise money.
You mentioned about the outliers. The power law states the small number of investments tend to drive the bulk of the returns in the VC portfolio. Has that held true for you in your earlier portfolios?
Absolutely. So I'm intellectually interested in power laws, and so I go back and I say, all right, well, what do my investments look like? And I think both they do end up being on a power law curve, and also it's somewhat predictive. So if you say like, well, they're going to end up on a power law, and where are they now? You can kind of say like, all right, what's going to happen here? And so it is definitely helped me in that way. I mean, you can't say like, it's predictive to a point, right? If it was really predictive, you'd say, well, I'm going to invest only in the companies that are at the top end of the power law and not the others, right? And you just you can't know which is which, right? But that line of thought where you say, well, I know they're going to end up with a few being outstanding and a bunch really kind of not working at all, but I don't know which ones. It actually helps you think about what you should invest in, right? Because if you say like, well, you know what, I'm going to invest in this great company, and then I'm also going to invest in this kind of like less than great company, like a company that's not quite as good. If you can say that, then you shouldn't invest in the second company because you don't know which one's going to succeed, but you can't pick companies that are that don't have the possibility of being the outlier, right? I mean, it's just if you could, then you would only pick the outliers and you wouldn't have a power law, right? So the idea that things turn out to be a power law no matter what you do means that you should only pick the outstanding companies, the companies that have the opportunity to be outliers, and everything else you just shouldn't pick. You shouldn't invest in, and that's just I think right. I mean, does that make sense? It's kind of a backwards way of thinking.
How do you understand that this is an outlier startup? It's a very difficult question. For example, do you believe on consensus in investment committees? How do you make your decisions? What is your framework?
So for me, well, the specific question, how do you know if it's an outlier, right? I mean, you can't know it's going to be an outlier, but what you have to be open to is the possibility of it being an outlier. Like, is
Hmm.
there a way for this to be $1 billion company? Like, is there a scenario in which this company is $1 billion company? And when you start thinking about it, it's kind of surprising how many companies can't be. So, I had a company come to me and said, "Look, we're using artificial intelligence to predict the stock market." Okay, and they wanted to raise money, and they were going to sell this software to hedge funds so they could make better returns. And you say, well, could this be $1 billion company? And the answer is clearly no, right? Because if they're successful, then everybody uses it, and then nobody makes money using it, right? So because it's a market that people trade against each other, so that nobody would then buy it, right? So the only way you could make $1 billion is if you used it yourself to trade, and if you were doing that, you wouldn't raise money from me, right? Because if you could actually beat the stock market, you would just borrow $100 from your parents or your grandparents and go out and start trading the stock market and turn that $100 into $1 million, then turn the $1 million into $100 million. Why would you need my money, right? Um, so there are some ideas where it can't possibly be big enough. And uh, another company I saw, one of the ones where the founder said, "Look, there's $50 million of revenue in this market, and we think we can take all of it, or at least 90% of it." Say, okay, that would be great. You would have 95% of this market, and I believed it, but it's still not an outlier, right? It's still, a medium-sized company. So I think you have to think about that. Yeah, sorry, keep talking. I'll keep talking, but that's the idea.
You get your own decisions while investing. Do you also, what do you think about the investment committees, which have several partners or lots of partners? Do you believe in consensus?
I doubt that partner committees really achieve consensus. I think they horse trade. I think what you have to do is not get everybody to believe you. And I think if you could get everybody to believe you, then maybe it's the wrong company. Like if everybody agrees that this is this is going to be $1 billion company, well, it probably won't be, right? Because the ones that become really big are the ones that are unusual. They're different in some way. If too many people believe it, then it's too easy an idea. But I think the having to go and defend your idea in front of other people and get them to buy into your story, at least the extent that they can't say you're wrong. I mean, people, there's a difference between people saying, "Well, you're right," and people saying, "Well, you may not be wrong." Right? So I don't know. I don't think any of my best investments, and I don't have an investment committee, but I have an informal group of people who are other investors and entrepreneurs who I will sit down and be like, "Here's what I'm looking at. Here's what I'm thinking about. I'm going to invest in this company. What do you think?" And really, pretty much all of them say that they don't like it always. um, and that's okay, right? But it's not. I don't. It doesn't bother me that they wouldn't invest or they don't think it's a good idea. I have to listen to their reasoning, right? Why don't they think it's going to be a good idea? Why don't they think it will succeed? I mean, if all of them said this is the best idea I've ever heard, I'd say, right, there's something wrong. But if they tell me like, well, I don't like it because X Y Z, I can go back and say, all right, well, is that true, right? It helps me. They help me think through these ideas. So I think having to present your idea before other people and say, this is something I believe in. Here's why I believe it. They're going to ask you good questions, and then you're going to have to think about whether you've thought about those other, contingencies or issues or whatever they are.
You have a diverse background from starting a career in engineer at IBM, I think, and
Mhm.
also how did you become a venture capital and now also writing?
So writing. I always wanted to be a writer. I really, the world is made out of words. I think if you want to make a difference in the world, you have to be able to write, and I think that's just a belief I've always had. But I don't think I'm a good enough writer to make a living as a writer. The But I was an engineer. Yeah, I was an electrical engineer. I worked for IBM. I helped design a very, very small part of their one of their last mainframe designs. So the ES9000, which I think might have been their last mainframe design because I think they just took that design and just shrank it over and over. But I liked to build things. The problem was I really wasn't a world class engineer. So at some point I'm like, okay, I can't be the best at this. right? I can't be the best in the world of this. I can't even be the best in this building at this, the building where I worked. So I decided to go look at other things and see what else there was in the world. And I ended up, as people who don't know what they want to do often end up, in consulting. I did some management consulting, did some bankruptcy consulting, and then the internet came along, and I said, "Hey, this is a big idea. This is like what I've been waiting for." And I joined one of the early internet companies back in 1995. Worked there for a few years, and then I was hired by a big company in New York that wanted to buy internet companies into their, as just they want to acquire internet companies, and they hired me to look at internet companies. Um, and within 2 months, we realized that you couldn't back then buy a good internet company because nobody would sell it to you. Only the people who had bad internet companies would sell them to you in the 90s. But you could invest in them. So we started investing, and I ended up in venture capital completely by accident. So we invested in a bunch of companies and went well. I left later to start my own company. And then when I left that company, I decided to start investing again. And that's what I've been doing since, is investing. I mean, the writing is, I like the writing, but it's a sideline. It doesn't really pay the bills.
In your book, Founder and versus Investors, you provide the insider perspective on the venture capital industry. How has the feedback from the founders and also fellow investors after the book came?
Everybody likes the book. Everybody likes the book, except half the people like my half of the book, and half the people like Liz's half of the book. And the people who like my half of the book hate Liz's half, and the people who like Liz's half hate my half. So it did exactly what we intended it would do. The idea behind the book was almost every other book that is co-written, there's a single point of view. So people cooperate in coming up with a point of view and putting it on paper. Liz and I have very different points of view. So we decided that instead of having a single point of view, we would have two different points of view, our own points of view. And I would write a part, and then she would respond to it, and then I would respond to her response, and we would go back and forth. And the idea wasn't to compromise, because we didn't really believe, the books where there's a compromise in venture capital, where they say, like, here's the best thing for both sides to do. That's not very useful, because that's not usually what happens, or it's not always what happens. Sometimes it happens, right? Like everybody's happy. And, I certainly have had people say, I'm an entrepreneur and I've never had any of these problems with my investors. And I say, well, how long have you been an entrepreneur? And they'll be like, well, a year. I'm like, okay, call me back in 10 years. I think everybody has problems, in the relationship, because you're at odds. You have different goals for what you're doing. Like, the venture capitalist is trying to make money. I mean, that's their job, right? They're managing people's money, and the people whose money they're managing are saying, get me the best returns. And that's not their only goal, right? But it is one of their goals. And then the entrepreneurs aren't necessarily in it to make money, right? I mean, there's easier ways to make money. You could just go, work at a hedge fund or work in real estate fund, or there's easier ways to make money than starting a company. They're in it to build something, right? And probably to build something lasting that means something to them. So you start with these kind of different goals. Of course, there's going to be conflict. So we wanted to bring the conflict front and center and say, look, here's what I think as an investor, and both of us are a bit playing a role in the book, right? Where whenever she said something like, well, investors aren't that bad, I would say, you got to take that out. Whenever I was like, well, entrepreneurs are sometimes right, she said, she can't say that. So there is, we did try to kind of play the roles that we were inhabiting in that book, but it is definitely an unusual book. I know of no other book where people have written back and forth like that, except for like books of letters, like literary letters. And I think it worked out okay. It's I like it. People seem to like it. But it's definitely an unusual book.
One of the premises of the book is also founders and investors have fundamentally different incentives that you mentioned right now,
Mm-hmm.
and the goals when it comes to startups especially. And what are the common misunderstandings that arise from these different incentives? Especially VCs have probably they have similar incentives when investing, but in a 10 years period, I think all incentives and motivation is completely different from the VC side and the entrepreneur side. What are the misunderstandings?
Yeah. So again, I don't think that VCs only care about money, right? I mean, VCs also, any who's good at VC could have gotten a job at a hedge fund or a private equity fund or something that has a better expected return. at least, so, or if they were really good at operations, they could have become an entrepreneur themselves, which probably, I don't know if it has a better expected return, but certainly has more variance. But, the idea that VC's job is to maximize returns, right? That's like how they are graded in a way, right, by their investors. I think it leads to things like some entrepreneurs will, after a couple of years, will say, I think we're doing well enough. Let's sell the company. We'll all make some money, and then we can go off and do our thing. Investors will say, no, like, we don't want you to sell the company. Why do you want to sell the company? Like, are you not the person to run this company anymore? We think this company could be a really big company if you kept going for another 6 years. So even to the point where they could say, well, we think there's a chance that it could be a much bigger company, and then there's a chance it will go bankrupt, right? And for an investor, from a venture capitalist, the chance of, maybe, let's say it's 50-50, it goes bankrupt versus is worth 10 times more. Well, obviously they're going to go for the 50% chance of being worth 10 times more, right? It's not the same if you're the founder, right? Because that 50-50 chance means there's a 50-50 chance that you're out of a job and have no money, right? Whereas if you sold the company now, you might walk away with $10 million, say, right? And $10 million is a lot of money for a person, right? So if you're the founder, you're like, I could walk away with $10 million today, or a 50-50 chance of having $100 million in 7 years. It's not, that kind of risk is not linear, right? Like, there's a certain amount of money you really want to have to be comfortable, and then the rest is sort of gravy. Whereas to an investor, it's not the same, right? So that's a place where you often see founders saying, look, I'm ready to be done here. I'm ready to cash out and make some money, and the investor saying no, right? And in my limited portfolio, I've seen that twice, where founders have said, hey, we could sell this company for $30 million or $50 million, and you'll all make your money, even make 2 or 3 times your money, and I'll walk away with $10 million, and we'll all be happy. And the investors have said, that's not our goal, and you're fired, right? Because they're like, you clearly don't believe in this company anymore. We need somebody else to run it. So this is one of those things we have to be careful. It's not all the investors, but whoever's on the board of directors could say, let's bring in somebody who really wants to build this company to be a much, much bigger company. So there's that kind of thing, right? Like, questions about growth, questions about raising more money. The founder might say, hey, if we could grow more slowly and not have to raise more money. And the investors will say, well, we think you should raise more money and grow much more quickly. And by the way, we're willing to give you that money and take part of your company. And there's that trade-off as well that often happens. So there's a bunch of different things that where the different goals start to clash, and the founders and the investors have really different viewpoints on what should happen.
Do you get board seats?
Do I?
Yes.
Sometimes. I'm a small investor. I invest really early. Often if I'm the first investor, will be the only board member, along with the founder, right? Or it'll be the 2 co-founders and me on the board for the first year. And I guess I've sat on 15 to 20 boards. And usually what happens is I will do that for a couple of years. When they raise the Series A, I'll usually leave because, unless they really want me to stay for some reason, to be the independent. But I feel like at that point, they're in probably better hands than mine, when they have other investors on the board, and I can go help somebody who's earlier along.
What constitutes the effective startup board composition in early stage and scale up?
So I think early stage, you want a small board. I think you should always have an investor on the board, and that's not entirely self-serving. I think because they do add a certain perspective that you may not have, right? Which or not that you may not have, but that you may not think about often enough. So it's always nice to have somebody who has a longer term view, saying, hey, you got a lot done this month, but you really didn't move forward the company towards that long term view, right? You didn't do what you hoped you would do. You got a bunch of code written, you talked to a bunch of customers, but nothing happened, right? And being able to go in and say, like, look, I know it seems like a lot happened for you because you're in here day after day, in the weeds, getting the work done. But when you look at it from 30,000 feet, not much has happened. So let's talk about what you need, what your goals are, and how to get them done versus just working. And that's true, I think, of anybody who does any job, right? You get stuck in your job and you're head down working on stuff, and then at the end of the month, you're like, all right, what did I get done? So it's good to have somebody who has that longer term perspective. It's good to have somebody, frankly, who has relatively simple goals, right? So if I'm an investor and I have a relatively simple goal, which is I want this company to be big enough to go public someday. Um, it really boils down a lot of the thinking it makes the thinking a lot sharper, you know? Like, is what you're doing progressing this company towards going public in 7 years, versus the kind of like when you're managing a company, you've got 1,000 issues happening at the same time. It's sometimes hard to figure out how to prioritize them. So it's nice to have that outside person. And I feel like that's what I do as a board member is like, tell me what you've been doing. Let's talk about it. Let me refocus you on the big picture. And I think founders appreciate that because they're buried in detail, especially in the early days. I don't think you should have more than 2 investors on the board in the early days because they tend to disagree with each other. And then you get weird advice. A later stage board, you're going to have a bunch of investors, right? If you've raised 3 rounds of capital, you might have 3 different VCs on your board. And obviously you don't want the VCs to, if you can, you don't want them to be a majority of the board, but at some point they will be. So it'll be like, you'll have you and maybe your co-founder, and maybe you'll have an outside director who's not an investor to balance it out. But boards get really unwieldy once they get big. If you have a board of more than 5 people, there's going to be people who are grandstanding, people who are disagreeing, people who want to micromanage. It becomes difficult to manage. And, so I think keeping a smaller board is better. I think it's more useful. I think you'll have fewer surprises, less fighting, that kind of thing. So that's I
How,
think, definitely different early stage, late stage.
how does a good template of a board meeting agenda runs?
So I think I have pretty strong feelings about this. I've been on boards now for, I don't even want to say how long, 25 years. And I've also, my first venture capital job, I was working for a big company. I reported to the CEO and CFO of that, giant company. They were a public company. They had a board. So I got to see the blow by blow of how they organize for board meetings and also get the afterwards when they were talking about it, I got to hear that. And I think there's a big difference between how they ran a board, which is, here are the issues and here are our solutions, versus how I've seen a lot of founders run a board, which is, here are our issues, give me solutions. And I think you really, as a founder, you don't want to ask your board to tell you how to run the company. And some investors are like, well, it's fine. If they want to ask me how to run the company, I can give them, I have a lot of experience. I have a lot of advice to give. I've maybe run a company myself. And if not that, at least I've been on the boards of many companies and seen how they run. So if they want to ask my advice on how to run a company, why wouldn't that be okay? And I think that answer from the VCs lacks introspection, right? I've invested in a founder. I have given a person money to start a company. The reason I did that was because I want them to run the company. Like, I am, in some sense, hiring them to run this company. It's their job. If they can't do their job, you have to wonder if they're the right person for that job. Right? I mean, in any job, if you're working for a big company and your boss brings you in, you're like, let's do our weekly sit down, and here's a bunch of here are the 3 things you were supposed to get done this week. How'd you do? And the person's like, I didn't get any of them done, and I'd like to ask you how I can get them done. Your boss is going to be like, wait a minute, why did I hire you? Right? You would never do that. And I think as an entrepreneur, you should never do that with your board. You walk in, you say, we have this issue. Here's 3 ways we thought about to solve it. Here's our 3 options. We think option number 1 is the best. And here's why. And then they can tell you what they think of your idea. They can kind of critique your idea. They can improve it. But at least you're going in there showing leadership and saying, I know how to solve problems. I'm doing my job. I'm solving these problems. Would love to have you tweak my idea and help make it better. Or tell me if there's something I don't know and I'm doing this wrong. But I'm not asking you to come up with ideas. So I think I think this is actually really important, and people don't agree with it. But I've just seen bad outcomes over and over again when people don't do this. And the best founders that I've worked with do this, right? They walk in, they're like, here's the problem, here's the solution, let's talk about it. And the thing, of course, is that I think most people, including most venture capitalists, don't realize is when founders do that, they don't notice it, right? They're not like, wow, this guy's a great founder, or this woman's a great founder. They don't notice it. They're just like, okay, that person's just doing their job, right? So there's no reward for doing your job. there's only like punishment for not doing your job. It's they remember people who've done things badly. They just don't remember people who've done things perfectly because it just seems normal. But I think that's I don't know. If you think about it, it's clearly true, right?
If you go, I mean, look back to 25 years, what was the worst experience that you have experienced in the board meetings?
Jeez. The worst experience. Actually, I don't think I can tell you the worst experience. You know, I think well, here's a funny story. Okay. I was in a board and there was a new board member, and the new board member had just joined one of the venture firms that had invested in the company, and he had just sold his startup. So he had started a company, and that wasn't a startup. He started a company, he grew it for like 7 years, he sold it, made a bunch of money, and then he went to join this venture firm with the venture firm that had backed him. And they wanted to put him on boards because he clearly had been an operator. He understood how companies run. And this was a little bit later stage company than I'm usually on the board of. So he came to the board meeting, and the founder, well, this was not just once, but like 3 times in a row, 3 board meetings in a row, the founder would say, here's what we're doing. We're doing this, we're doing that. Here's a problem we had. Here's how we're solving it. Doing his job, the founder. And the board member, the new board member would come in and say, look, that's not how you should do that. You should do it this way, this way, this way, this way. Here, let me give me the list of your customers. Let me go through them with a pen and tell you which ones are important, which ones you shouldn't pay attention to. And in the end, really micromanaging the founder. And it's because he was running a company. He was used to managing people, right? This was, what he did to build his company. But the founder was getting really frustrated because the founder said, I'm sure, was saying to himself, you're here once a month for 3 hours. I'm here, 168 hours a week, every week. I'm doing this as my job. It's all the time. And I'm thinking these things through. You're offering me suggestions I thought of and discarded. So this happened for a little while. And I had been talking to the founder outside of the board meeting. And in this third board meeting, I finally just said, look, this is ridiculous. If you want to run a company, to the board member, then you should go run a company. Like, don't run this. You're not here to run this company. And we kind of got into a bit of a verbal fight. But, in the end, like afterwards, he not that same day, but the next day he came and said, hey, thank you. I'm sorry. I was thinking about this wrong, but you're right. I need to be their partner, not the boss. And that person actually ended up being the best board member of all the board members, and myself included, because he did become their partner. He helped the founder, like outside of the board meetings, get things done. He'd say like, hey, I'm here to help. How can I help? And the founder would say like, all right, we're thinking about this problem. I need a solution before the board meeting. What do you think? Which way do you think I should go with this? And he'd say, okay, here's what I would do. And they became like really close. I think that partner really helped guide that company towards its eventual acquisition. So, in the end, it was a good thing, right? But that kind of micromanaging in the board meeting was it's difficult, right? It's bad for the company. It was driving me nuts personally. But and I think once that partner figured out his job, he was great.
You
So
have different opinions about competition. The role of uncertainty
yeah.
play success of what does the uncertainty play in the success of startups?
So there's a distinction, and so uncertainty. There's no great word for what I mean by uncertainty in English, at least. I'm talking about what's called Knightian uncertainty or ambiguity, or people call it different things. But what it means is there's risk, right? Risk is like you have a distribution, like, well, there's a 50-50 chance this will happen. That's risk. But uncertainty is when you can't even know the probabilities, right? You can't say what the probability is, right? What's the probability that there are? I can't even think of a good example, but what's the probability that, like, when Steve Jobs started Apple with Steve Wozniak, what was the probability that the personal computer would be a huge success?
We don't know.
Yeah, there's no way of knowing, right? Anybody, or how many people would buy them, right? There was no way of knowing, right? Because there wasn't enough information. Nobody had done it before. So you could guess, you could make up statistics, but in reality, you just don't know. And I think this theory, the Frank Knight's theory, and the theory that I believe is that every startup has this uncertainty. There are things you just can't know. You can't put probabilities on them. You just have to hope that they'll happen, or work around them somehow. And the reason that every startup has these is if you don't have them, then big companies will say, well, this seems like a good market, because people believe that big companies won't take risks, but that's clearly not true, right? I mean, insurance companies exist to take risk, right? So if you're doing something risky, big companies will be like, okay, well, there's a 20% chance this will succeed, but is it worth it, right? Will we make enough money in those 20% of times that it's worth investing in? And also, instead of doing one of them, we'll do 10 of them. So even though there's a 20% chance that any single one will succeed, if we do 10 of them, then you have a pretty good chance that two of them will succeed, right? So we'll end up making money. We won't have this kind of variability of earnings. They can work around risk, right? But they can't work around uncertainty. And so if a company doesn't know what will happen, they'll often just avoid the project entirely. So there was a company that I had met. I had met the founder, really loved the company. They were too late stage for me. They had already raised their seed. They were at their Series A, but I loved them. So I introduced them to a bunch of people who could invest in their Series A. And one of them was a corporate investor. And the corporation that he worked for would end up competing with this company if it succeeded. So I said to him, they invested, and after they invested, I asked the person, I said, why didn't you just start this internally? Because you invested $2 million, you could have started it internally for half that, because you already have all this infrastructure. And he said, well, I would not be able to convince my boss that we should start this because we have no idea if it's going to work or not. Whereas investing some money is different. I said, well, but you never really know if anything's going to work. He's like, well, that's not true, right? I mean, if I walk into my boss's office and I say, like, here's an idea, he's going to say, well, all right, how big is this company going to be in 5 years? How big is this idea going to be? How much revenue will it have? Well, what does the income statement look like for the next 5 years? And if I say, I don't know, then he's going to say, great, come back when you do, which could be 3 years later. So if you had walked in, well, this is at IBM, right? When Steve Jobs started Apple, IBM was a huge company in America. I think it was one of the top 5 biggest companies in America, probably in the world. They built computers, and they'd been building computers for decades. Why didn't they build personal computers when in the 1970s? And the answer was, well, they had no idea if there was a market or not, right? So they had to wait until everybody else proved there was a market. So when IBM entered in 1981, there was clearly a market for personal computers, right? Millions of people had bought them. Apple had already gone public. They had $100 million in revenue and gone public. And IBM said, okay, there's no more uncertainty here. There's still risk, but we know there's a market. And so then they entered, and they drove everybody else out of business except for Apple, because there were dozens of personal computer companies before IBM entered. But Apple managed to survive because they had gone public and raised enough money that they had a base that they could survive the onslaught. So they used this uncertainty, right? As a startup, they used the uncertainty as a moat to keep everybody else out of the business. Nobody wanted to enter the business because it was uncertain, at least the big players. So they could survive until the market was proved, at which point they had a product and enough of a base that they had a different moat, right, than this uncertainty. Yeah, no, I think that if you don't have uncertainty when you start, if there isn't something you don't know, then you're probably not going to be able to build the company. So, a great example I love is remember the Pebble watch? Do you remember the Pebble watch?
Yes, sure.
Yeah, right. So they raised money on Kickstarter. They're the most successful Kickstarter to date. They've had the watch out. People love the Pebble watch. I mean, mostly it didn't connect to your phone that great, but it was a great product. And Apple came along like 2 years later and said, hey, this is a great product. We should build that product. And they just basically built a product that was functionally very similar to the Pebble watch, and they put it out, and Pebble went out of business, right? I mean, they disappeared. Pebble didn't have a long enough period of uncertainty for them to compete with Apple, right? Because they had to, in the end, compete directly with Apple. So, this is my theory, and this is when I look at companies. If there's not enough uncertainty, or if there isn't uncertainty about something really basic, something really central, then I have to say, well, how are you going to survive everybody else coming in and saying, well, this is an obvious market. We're going to enter this market and compete with you, and we have $1 billion company to compete with you with, right?
I think this can be a variable of outlier startup. If there's an uncertain market, so it's a huge opportunity, and startups may be the first in that market because there's no competition at all. So if the startups have the iteration, trial and error, and making this market happen and keep the pioneer, Pebble couldn't make it, but if they be the Apple of that market, that will be an outlier startup as well.
It would have been. I think, yeah, no, I totally agree. And I think if Pebble had had another couple of years, they could have built some way of keeping Apple out of the market. I mean, it was a difficult battle in the first place because Apple had the connection to the phone. I mean, they had some structural advantages, but I think Pebble just didn't have enough time having the market, having no big competitors to build up some other way of keeping people out of the market, right? Either a brand or um, probably not economies of scale, but maybe economies of scope, right? Something, a network effect, something that would have given them a way of keeping others out of the market. But yeah, no, I think I generally regarding competition, which I think is where you started. I mean, I agree with like Michael Porter, right? Like you should avoid competition, right? Everybody is like, well, it's competition. That's the free market. Like competition is great. It's like, no, competition is bad, right? It's which are you more likely to win? Are you more likely to win like the Boston Marathon, right? With the biggest race in the world, or a 5K in Oklahoma, right? There's just fewer competitors there, right? Like you're not competing with as many people. You're more likely to win. Now, if what you really want to do, if what you're hoping to do with your startup is just compete like heck because you love to compete, well, okay, go, why don't you could start a personal computer company and compete with Apple, right? But if what you want to do is win, then you should find a place where there's less competition. So I think this is the idea, right? Like if you to have less competition, you have to be able to exclude people from entering your market somehow. This is just what the idea behind a sustainable competitive advantage or a moat, right? Is you're excluding people from entering your market, and then you have less competition. But if you're going to do something where you can't exclude people, well, you're going to have a lot of competition, and it just makes it much less likely you'll succeed. You may be the outlier where you are the best freaking operator and that nobody knew about, and here you are, and you're running a much better company than everybody else, including the people who run the biggest companies in the world. Um, but that's unlikely. It's unlikely, right? And that's the kind of risk that I'm not going to take as an investor. Is say, well, you know what I'm betting on? I'm betting on the fact that you are a better CEO than Tim Cook. Like that's not the bet I'm going to take.
While we were talking about competition, do you recommend any competition slide template? Because when we look back, lots of early stage startups presentations, competition slide is lots of checkboxes and comparison matrix. What is your opinion on that?
So now, I teach this course on entrepreneurship at Columbia, and we talk about this. So there's a confusion in my mind between what I teach them and what people actually do. I think the point of these competition slides is not who are you competing with. The point is how are you competing, right? Like what does your customer care about, right? What are the things they really care about the most, and how are you different than the existing competition along those metrics? So you used to see, I'm sure you used to see as well, those kind of the 2x2 matrices where people would be in different parts of the thing, and the best your company would be in the upper right hand corner. The point of that is not the matrix or the companies that are in it. The point are, what are your axes, right? What are you saying are the things you're measuring that you're different from your competitors against? Are those things really what's important to your customer, right? And if you think about that, what is important to my customer, and how can I be different than my competitors? That's the important part about competing. And I think the check boxes are interesting, but they're almost entirely useless, right? Because I've never seen one of those where it wasn't like, well, here's 12 different things that product features, and almost all the boxes are checked by everybody except you have like one checkbox that's different. So the important thing there is, okay, you are different along one dimension, right? What one dimension of competition you're different in? Why is that dimension the one that's most important, right? Let's talk about that. And how big of a market does that get you? How do you prevent others from just checking that box also, right? So it's that what's the dimension of competition, and how are you going to be A, different, and B, either better or exclude others from it? That's, I think, the exercise.
You teach a course on entrepreneurship and innovation at Columbia University. What are some key lessons you try to impart to aspiring founders in your class?
Okay, so don't tell anybody I told you this. It's true in a way. They when they hired me to teach the class, they asked that it be rigorous, and I'm not really sure what they meant by that because I'm not a PhD. I don't, I I asked myself, what do these students need to know? And I think the answer I came up with, and it's at the engineering school, by the way, not the business school, the engineering school. So I'm teaching engineers how to start companies, and that's to me is the highest good. But what do they need to know? I think, do they need to know how to do a lifetime value? Do they need to know how to do a business model canvas? Do they need to know how lean startup works? Yeah, I think they need to know those things, and I teach those things. Are those things hard to learn? No, they're not very hard. Are they hard to get right? Well, yeah, right. I mean, I'm actually in the middle of grading papers right now, which is why I'm talking to you instead. But they had to the papers, they have to design an MVP, and it's hard to get an MVP. Like what many of the MVPs are their entire product. So, no, that's not an MVP. So it's hard to get them to get the idea straight in their head. But they're not. None of that stuff is conceptually hard, right? I think the hard part, especially for engineers, is knowing that this is an option for you, right? That you can be an entrepreneur, right? You can be an entrepreneur. And I was an engineer, and I by the way, I was an engineer. I was a total computer geek growing up, and my idols when I was growing up were like Steve Jobs and Bill Gates, right? And but when I graduated from engineering school, it never occurred to me that I could start a company also, even though I knew their entire life histories, right? And the reason it never occurred to me was because I'm not Steve Jobs, right? Like I'm not Steve Jobs at all. And I say, well, okay, you have only these heroic people can start companies. So you know what? And then as I worked for a while, I realized that that wasn't true. That nobody is Steve Jobs, including Steve Jobs, and that people who start companies are just regular people who have good ideas and are willing to work hard. So this is what I wanted to teach them. Like, anybody can start a company. Anybody who wants to start a company can start a company and potentially be successful. That's lesson one. Lesson two is failure is not failure, right? In the startup world. So a lot of these people, they got into Columbia by being perfect their entire life, right? Up to date. They went through 20 years of being perfect. They got into Columbia. Um, and they're afraid of not being perfect, right? Because being perfect for 20 years, like I wasn't, I don't know many people who were, but being perfect for 20 years becomes a habit of being perfect. And so they're like, well, how can I continue to be perfect? And it's certainly not by starting a startup, right? Because there's an excellent chance you're just going to fail. So I have to convince them that even if you start a company and it doesn't work, that's not failure in your life, right? I started a company and it didn't work. And then I went on to invest and I'm successful. I think, there's that, like it's different when you're doing a startup that people don't think of like, well, your company didn't work as being like, well, we should never speak to them again. They should never hold a job. Maybe they should be out, sweeping streets or whatever. So that's lesson two. Was there a lesson three? There is a lesson three. Lesson three, and this is especially true for engineers, you're not going to know the answers, right? There's no answer. It's you have some goals, but your goals will change, and you have to kind of embrace that there is this uncertainty to start, and then even as you go forward, what you're trying to do should change depending on what you find out about the world around you, about your customers, about the market, about your competitors, and this is hard for engineers, right? Because for an engineer, like when I was an engineer, I would get a problem set as homework, and the problem set would have a question. Some of the questions were quite hard, but they all had answers, and they all had correct answers. And when you got the correct answer, you pretty much knew that you were correct, right? So, if an engineer is designing a bridge, they're saying like, well, I'm a civil engineer, I'm designing a bridge. This is the bridge I designed. It works, and it is the best bridge for this site, right? They can know these things because it's a finite universe of solutions, and there are things which are considered like the best possible solution. It's not true in startups, right? Like there's not a finite set of solutions. There isn't a best solution. You won't even know if you're succeeding once you've succeeded, right? You could go public and be like, I wonder if this company's working. It's an entirely different way of thinking about it, but it's so getting engineers to kind of let go of the certainty and say like, what's uncertain about this? What might go wrong? How should I adjust the company 2 years in if things don't work out the way I thought they would? You know, that I think is the third thing that I try to teach them. And I do, obviously I teach all the other stuff like here's how you do an MVP, here's how you do a lifetime value, blah blah blah. But again, none of that's rocket science.
Thank you so much for joining me today, Jerry. It was incredibly enlightening to hear your thoughts on embracing uncertainty, dynamic between founders and investors, how you shaped the next generation entrepreneurs in the Columbia University, by the way. And are there any next books coming?
I'm still recovering from the last book. Yeah, no, I think there'll be more, but they will. I don't think they'll be different than the one we just wrote. But I'll let you know when the next one is close to being released. Thanks for having me on. I appreciate having the chance to talk to you.
Thank you very much, Jerry.